Welcome to HouseLuxe Estate, where we simplify the complex world of real estate and investment for you. We're here to illuminate the path to financial growth, whether you're a seasoned investor or just getting started. Our mission is to provide you with insights, strategies, and tips to navigate the ever-evolving investment landscape. At HouseLuxe Estate, we understand that the world of investment can be daunting. That's why we're dedicated to demystifying it, making it accessible, and even enjoyable for everyone. Today, we're going to focus on an exciting investment strategy that's both rewarding and sustainable: investing in dividend stocks for passive income. Imagine making money while you sleep, while you travel, or even while you're just sitting on your couch. Sounds like a dream, right? Well, with dividend stocks, this can become your reality. So are you ready to explore this fascinating world? Stay tuned as we delve into the exciting world of dividend stocks. Before we delve into the process of investing, it's essential to understand what dividend stocks are. Picture this: you're part owner of a thriving business. As the business prospers, you get a share of the profits. That's essentially what happens when you invest in dividend stocks. You're buying a tiny piece of a company, and when that company does well, you reap the rewards. But let's break it down further. A dividend is a portion of a company's earnings paid out to shareholders. That's you, the investor. These payouts typically occur quarterly, though some companies may pay monthly or annually. Dividend stocks, then, are stocks in companies that pay dividends. Now you might be thinking, why would a company give away its profits? Well, it's a way for companies to share their success with those who believed in them enough to invest. It's also a sign of a company's financial health. Companies that consistently pay dividends are often stable and profitable. One of the key benefits of investing in dividend stocks is the potential for passive income. You invest in the stock and then sit back and wait for the dividends to roll in. It's a way to make your money work for you rather than you working for your money. It's like having a second job that requires no effort on your part. However, it's worth noting that not all companies pay dividends. Some prefer to reinvest their profits back into the business for growth. These are typically younger, growth-oriented companies. On the other hand, established companies with steady cash flows are more likely to pay dividends. Another benefit of dividend stocks is that they can provide a buffer during market downturns. While the price of the stock may fall, the dividend payments can offer a steady stream of income. In sum, dividend stocks represent an ownership stake in a company that shares its profits with its shareholders. They offer a passive income stream and can be a solid addition to a balanced investment portfolio. Now that we know what dividend stocks are, we can move on to the steps to invest in them. The first step in any investment journey is research. Now, let's delve into the world of dividend stocks. When investing, you must look beyond the allure of high dividend yields. It's crucial to consider the dividend payout ratio too. This ratio indicates what percentage of earnings a company is paying out as dividends. A lower payout ratio may mean the company has room to increase its dividends in the future. On the flip side, a high payout ratio could indicate that the company is stretching itself too thin, which could lead to decreased dividends or none at all. You can find this information on financial news websites, brokerage platforms, and the company's own financial reports. It's also important to understand the company's business model and the stability of its industry. A strong and stable industry often leads to consistent dividends. Armed with this knowledge, you're ready to move on to the next step. The second step is diversification. Diversification is like having your eggs in different baskets. It's a risk management strategy that mixes a wide variety of investments within a portfolio. In the context of dividend stocks, diversification means buying shares from different sectors. For instance, instead of investing all your money in a single technology company, you could spread your investments across technology, healthcare, and consumer goods companies. This way, if the technology sector experiences a downturn, your investments in healthcare and consumer goods can help offset the losses. Diversification also extends to geographic location. Don't just stick to domestic companies. Explore opportunities in international markets as well. Remember, diversification isn't about guaranteeing gains or completely eliminating risk. It's about creating a balance where the good can potentially outweigh the bad. It's about having a safety net, just in case one of your investments doesn't perform as expected. With a diversified portfolio, you're well on your way to investing success. The third step is to reinvest your dividends. Now, what does that mean? Simply put, reinvesting dividends means using the dividends you receive to buy more shares of the company that paid you the dividends. This process can significantly compound your returns over time. Imagine a snowball rolling down a hill. As it moves, it picks up more snow, growing larger and larger. That's how reinvesting dividends works in your investment portfolio. Each time you reinvest your dividends, you're buying more shares. These new shares will then generate their own dividends, which you can then reinvest again. This cycle can continue indefinitely, creating a compounding effect that can significantly increase your wealth over time. However, it's important to remember that reinvesting dividends does not guarantee profits. The value of your investments can still go down, so make sure you're comfortable with the risks before you decide to reinvest your dividends. Reinvesting dividends is a powerful tool in growing your wealth. The final step is regular monitoring. Now, you might be thinking, I've got my dividend stocks, I'm all set, right? Well, not quite. The world of investing is not static. It's a dynamic, ever-changing landscape, and to navigate it successfully, you need to keep a diligent eye on your investments. This doesn't mean you have to check your portfolio every hour of every day. It simply means you should keep abreast of any significant changes that could affect your investments. Things like company earnings reports, economic indicators, and market trends can provide valuable insights. By regularly monitoring your investments, you can make informed decisions about when to buy more, when to hold, or even when to sell. It's all about optimizing your returns and ensuring your portfolio continues to grow. So don't just sit back and relax. Stay active, stay informed. Remember, investing is not a set-it-and-forget-it activity. Let's quickly recap what we've learned today. We've embarked on an enlightening journey into the world of dividend stocks, uncovering the secrets to passive income through smart investment strategies. We started by defining dividend stocks. These are shares in companies that distribute a portion of their earnings to shareholders, typically on a regular basis. Dividend stocks are a fantastic way to generate income passively, and they could be a great addition to your investment portfolio. Next, we delved into the first step to investing in dividend stocks: research. We cannot stress enough the importance of doing your homework before jumping into any investment. This means looking at the company's financial health, dividend history, and future prospects. Remember, a company with a strong track record of dividend payments is usually a more reliable bet. Then, we moved on to the second step: diversification. This is not about putting all your eggs in one basket. Instead, spread your investments across different sectors, industries, and even countries. This will help to mitigate the risk associated with any single investment. Our third step was about the power of reinvesting dividends. Instead of taking the cash, consider reinvesting your dividends back into more shares. This can significantly boost your income over the long term thanks to the magic of compounding. Finally, we discussed the necessity for regular monitoring. Investing is not a set-and-forget strategy. It requires vigilance and regular check-ins to ensure your investments are performing as expected. That way, you can make adjustments as necessary, whether that's adding new investments or letting go of underperformers. So why should you consider investing in dividend stocks? Well, apart from the potential for regular income, they also offer the opportunity for capital growth. This means your investment could increase in value over time, in addition to the dividends you receive. Plus, investing in dividend stocks can provide a measure of protection during market downturns, as companies with a history of paying dividends are often more stable. But remember, as with any investment, there are risks involved. It's important to understand these risks and make informed decisions. Don't be afraid to seek advice from professionals if you're unsure. We hope this video has given you a clearer understanding of how to invest in dividend stocks for passive income. The world of investing can be complex, but with the right knowledge and strategies, you can navigate it successfully. Thank you for tuning into House Lux Estate today. Don't forget to subscribe for more investment tips and tricks.